We went and analysed all of the tax depreciation schedules we produced in the last 12 months, and here are some of the things we learned. Hi everyone, Tuan Duong, founder of Joyotax, here for another video designed to help you become a better property investor. There's no doubt that the Australian property market has seen some massive value gains over the past 12 months, with property prices increasing by more than 20%. According to the latest data from CoreLogic, property prices across the combined capital cities and regions were up 1.5% over September, 4.8% for this quarter, and 20.3% for the 12 months to the 30th of September. This is the fastest annual growth rate since June 1989. But after a lengthy period of rapid price and sales growth, the Australian housing market sales rate has begun to grow more slowly. Home sales have fallen by around 10%, new home listings are down, and new dwelling construction approvals have dropped as well. So, what does this all mean for potential home buyers? Well, the Joyotax team analysed all the depreciation schedules we produced over the last 12 months, and we wanted to share some of the property trends we noticed. So, stay tuned. But before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax or investing advice. We always recommend working with a qualified financial advisor, property professional, or tax agent to give you the best advice for your situation. Let's start with what we're seeing between brand new and established properties. What we're seeing in our data is our brand new dual key properties have increased significantly by as much as 143% compared to 2020. But interestingly, second-hand houses have increased more than brand new, with a 147% increase on second-hand houses, compared to only a 109% increase on brand new, likely due to some of the building supply issues and the rising cost of housing. If you haven't already watched our video on whether to build a brand new home or buy an existing home, check out our video that covers this. The same is also true for second-hand granny flats. We've seen a 145% increase, while brand new granny flat builds have gone backwards, down to 89% on the previous year. Townhouses have remained on par with a 148% increase on new builds and a 151% increase on existing townhouses. Duplexes are also a similar story. A 115% increase on established and a 109% increase on brand new, although we see far more brand new duplexes. And lastly, apartments. A 116% increase on established apartments compared to a 123% increase on brand new ones. For commercial properties, new commercial properties have also seen a significant uptick, with a 224% increase on new buildings and fit-outs, whereas established commercial properties has only seen a slight increase of 111%. We're also seeing similar numbers with new office buildings and fit-outs, with a 240% increase. Now, onto areas and suburbs where we're seeing a lot of growth. One of the fastest growing suburbs we're seeing is for the postcode of 3029, with a 232% growth in tax depreciation schedule orders. Southbank in Victoria also saw some exceptional growth based on data, with a doubling of tax depreciation orders between 2020 and 2021. In New South Wales, Penrith and the surrounding suburbs of Emu Plains and Jamison Town saw a 222% increase too, which isn't surprising given the incredible development that is happening at the foot of the mountains. As has been the trend and the impact of COVID, Wollongong also saw a big spike in demand with 229% increase. We think this has a lot to do with more purchases of properties in regional areas and the increased ability to work from home. In Queensland, Coomera and the Upper Coomera near the Gold Coast have also seen a pretty big jump of 172%, while Caboolture, north of Brisbane, doubled in demand between 2020 and 2021. But two of the biggest increases have been Labrador with a 333% increase, and Richlands in the southwest of Brisbane with a 318%. SQM Research recently released a report on the 12th of November indicating that vacancy rates have fallen to 10-year lows, thanks to both Sydney and Melbourne driving much of that. Then when you combine some of the growth areas and the type of properties, we think it's still a great time to invest, as demand for rental properties, particularly houses, remains strong. Having said that though, individual suburbs, areas and regions all have different factors at play. You also need to consider your own goals and how all this data falls into place with helping you achieve your investment objectives. So while the overall data is showing growth in many of these areas we mentioned, this doesn't mean it always continues to grow. Anyway, hopefully there were some useful stats and trends you could extract from there to help you in your investment journey. If you know anyone who might find this useful, please make sure you share this video with them. I'm Tuan Duong from Joyo Tax. I'll see you guys next time.